Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. Thanks to Policygenius for sponsoring this video, but more on that later. In today's video, I wanted to create a mini tutorial. It's not going to be like an hour or an hour and a half long like some of my stock market for beginners videos, but this one's actually going to teach you how to invest in index funds the right way. It's going to be a very simple overview of pretty much what index funds are, what to look for, what questions to ask, and actually how to buy them. We'll do a live demo here at the end of the video. So without further ado, let's get right into it. So I threw this presentation together just because I feel like PowerPoints are the easiest way to learn. So let's start from the beginning here. What is an index fund? So index funds are baskets of stocks. That's why I use this image over here to the right. That's how you have to think of these things. Designed to replicate or track a specific market index. So if you're not familiar with what an index is, I'm sure you've heard of the S&P 500. I'm sure you've heard of Dow Jones Industrial Average, Russell 2000, et cetera, et cetera. There's a bunch of these different indices out there. The thing with index funds is that they're passively managed, meaning that there's not an active portfolio manager, which we'll talk about later in this video. The other thing is that since they are passively managed, they are typically able to give you lower expense ratios and fees versus actively managed funds, which I'll show you an example of here in the next slide or two. And they also typically match the risk and return of the overall index that they are tracking. So a lot of people think that index funds are always fairly priced just because of efficient market hypothesis theory. This is basically saying that, hey, all this information is available out there in real time, and these securities are trading at exactly their fair price at all times. Some value investors would disagree with that, but that's not the scope of this video. I did a little bit of research before this video, and there are actually 2,400 index funds that exist that are able to be traded on public markets. The first type that we have here is the broad market, ticker symbol VTI, for example. This is Vanguard's total stock market index fund. This contains over 4,000 different companies. So 4,000 different publicly traded companies is designed to mimic the broad market as a whole. Number two is market cap index funds. So these are broken down by large, mid cap, or small cap. If you don't know what caps are, that basically stands for market capitalization. This is essentially your share price multiplied by shares outstanding, which will give you different valuations. If you're looking for the definitions of large, mid cap, and small cap, you can check out my stock market for beginners video. Number three is equal weight. An example of this would be ticker symbol RSP. So say you're trading the Nifty 50. Say there's 50 stocks in this portfolio. Each stock is going to have a 2% weight in this portfolio. 50 times 2 is 100%. Number four is factor-based. So there's different factors that you can trade. You can have value, you can have dividend yield, you can have volatility, such as low volatility stocks. Number five is sector-based. So sectors are just different sectors of the economy, which you can see in the picture over to the right. You have things like energy, materials, banking, technology, et cetera, et cetera. Number six is international. It tracks a specific foreign index, such as like Hang Seng or Nikkei or the FTSE, for example. Number seven is debt, which are typically bonds. Moving on, we need to get into fees and what index funds cost, because this is a huge factor in what your overall returns will be during the course or during the life of this investment. So your expense ratio, the classic definition is basically your fees divided by total investment. But a much easier way to look at this would be, say, for example, you have $100,000 invested in a certain fund, and it charges you a 0.03% expense ratio. All you're going to be coming out of pocket is $30 a year. So you're not going to actually see this money leave your account. It's actually going to be reflected within the return of the fund itself. So you typically want to look for an expense ratio of 0.35% or less, especially if these things are going to be passively managed, not actively managed. Great ones are actually 0.1% and less. So I'm going to show you this example. I'm going to go to the next slide just so you can see it in a little bit bigger scale here. So we have two different investments. You have investment one, investment two. Investment one's expense ratio is 1%. Let's pretend you have your money with a traditional financial advisor who typically charges you anywhere from 1.5% and less. We're going to use 1% for their example. And let's say you're invested in something that charges you 0.03%. So over the course of this investment, let's say your initial investment is $10,000 up front. Let's just say you plop in 10 grand all at once. You add $5,000 a year for your annual addition. Your investment return over the course of 30 years, let's just say, is 6%. You can see the difference of $74,745 just in expense ratios over these 30 years. So investment one is going to cost you roughly $77,300. Investment two, with the much lower expense ratio, 97 basis points less, is actually going to cost you $2,566. Again, the difference being $74,745. And that's just with an investment of 10 grand plus 5,000 times 30 years with a 6% growth rate. If you invested much more, or if you're much more aggressive, these numbers and this difference is only going to become bigger and bigger. So what are some of the risks investing in index funds? Well, investing in general is risky. As investors, we are compensated for our risk. That's the whole point of being investors. If it was a risk-free rate of return, then the growth is supposedly not going to be as high. You're compensated for the amount of risk you take on as an investor. So the first risk is that it can rise and fall with the index. So depending on what you're invested in, let's just say you're invested in VTI, total stock market. Well, you can see what that's done since the beginning of this year. At the time of this recording, we're down about 16%, maybe a little bit less. Number two is that there's no downside protection because this is a passive investment. Okay, there is no active portfolio manager, maybe getting you out of the investment before trouble hits, or maybe taking advantage of downturns in the market. Which leads us to point number three, is that these index funds can't take advantage of opportunities. It's because they are simply tracking an index. They're not actively managed. Number four, again, stems from being passively managed, that you can't cut your losers. Again, there's no human cutting the losers and trying to optimize your return. They're simply tracking a basket of stocks, which form an index. That's why they're called index funds. And then number five, I think I've beat this point to death here, is that there is no portfolio management. They're passive investments. So let's talk about step number one. Okay, how do we actually get into these things? How do we start buying these things? But we first need to understand, hey, I've done my research. I understand what an index fund is, but now we need to pick one index or multiple indices. So we want to construct a long-term portfolio. That's the beauty of index fund investing. Index fund investing, you're not sitting here day trading. You're not sitting here swing trading. I mean, you potentially could. A lot of people trade the SPY, which tracks the S&P 500. However, in the context of this channel, we're talking about constructing a long-term portfolio that you're not going to FOMO in and out of, right? Fear of missing out. So number one is, think of this like a pie, okay? Over here, that's why I use this picture specifically. This is just an example of a three-fund portfolio. It's called 80-20 because 80% is dedicated towards equities, 20% towards bonds. Number two, you can look at large cap, so like S&P 500 or total market, like VTI, for example. If you want to look at like small cap value, you can look at ticker symbol AVUV. This is Avantis's small cap value fund. You can look at international funds, VXUS. This is Vanguard's international ETF or index fund. And then number five, you have BND, which can comprise of basically bonds, which make up this 20 in this 80-20 number right here. So you can assign weights to this portfolio. So when you think of your pie, think of the slices having different weights. So say, for example, if I'm going to go with a large cap, a small cap, an international, and a bond, you can do 50% of the large cap. You can do 15% of the small cap value. You can do 15% of the international. And if you want to keep that 80-20 intact, you can go with 20% of BND. Make sense? This is just an example, you guys. You don't have to do this. So step number two is picking the proper fund. So there's different types of large cap. There's different types of international. There's different types of small cap, for example. So you need to ask the right questions before investing in an index fund. So number one is, which index tracks the index you're trying to track best? Okay, there's different types. What is the expense ratio? Again, we saw in slide number 2 or 3 how important having a low expense ratio is over time, especially if you're going to be invested for any significant portion of time, like 10, 20, 30 years, for example. I would personally go to ETF.com and read. Each one of these brokerages or whoever's offering these different index funds is going to have a prospectus. If you want to check them all out at once, ETF.com is a great example, which we're going to do right now. So this is ETF.com. It's a great website. I have no affiliation with this website whatsoever, but they have top news. They have different head-to-head comparisons of different index funds. Like right here, you have SPY versus IVV, for example. You have VTI versus ITOT. There's a lot of different things that you can do research on. But if you're looking for a specific fund, all you have to do is type in the ticker symbol. So I typed in VTI. Typically, the first article is just going to get you to the index fund overview page, and you can see their different gradings. You can see all the different things that comprise of the index fund. You can see right here, here's VTI's summary data. You can see its inception date. It's about 21 years old now. You can see its expense ratio, 0.03, just like in our example. You can see how many assets are under management. It's got over $250 billion invested in it. So you can see how popular these things are and what the ins and outs of them are. You can click on things like efficiency. You can see what makes up the top 10 sectors. You can see what makes up their top 10 holdings. In this case, 6% of VTI is made up of by Apple, Microsoft, Amazon, Tesla, Alphabet, very tech heavy. And you can see that from right here. You can see that technology makes up 15.27%. So these are some things that you need to do before, obviously, investing your money. You can't just blindly put your money in an index fund and hope that it goes up. You need to understand what's in this index fund and why you're investing in it in the first place. So step number 4 in picking the proper fund is understanding if you have too much overlap in your portfolio. So let's just say you decide to invest in multiple index funds and multiple ETFs. You need to understand if you have overlap. The reason for that is because you may have a very inefficient portfolio. So say you have a portfolio of $100,000 and you split it 50-50 between two different funds. Well, if there's a lot of overlap between those funds, you're A, not getting proper diversification, B, you're just doing the work twice for no reason, right? You're splitting up your money in two different funds when you're essentially buying the same exact equities from each fund. So I'm going to show you exactly how you can check this out right now. So this is a website called etfrc.com, basically stands for ETF Research Center, which you can see right here. The cool thing is that they have a function or a tool on their website that shows you fund overlap. So if I was going to use the example that I just talked about, if I want to find the overlap between VTI and SCHD, for example, you just put in the two ticker symbols and it'll show you exactly what's overlapping and what percentage is overlapped by weight. So between these two funds, we have 98 overlapping holdings. So 2.7% of VTI's 4,000 holdings, which I mentioned earlier, are also in SCHD, and 99% of SCHD's 103 holdings are also in VTI. So this sounds kind of pointless at first to invest in both of these, but I'll show you why it necessarily isn't. You have to look at the overlap by weight, okay? Remember, there's different weights in these different index funds. Index funds are just a basket of stocks. Typically, these are weighted by market cap. So say, for example, Apple being number 1 in VTI was probably because they have a really big market cap. So the weights between these two ETFs aren't necessarily going to be the same, which means that you may not have that much overlap, even though 99% of SCHD's holdings are also in VTI, if that makes sense. So you can see the different weights here. You can see the top 10 entries. You do have to pay if you want to open up some premium features, but you can see all the different overlapping equities right here. So this is a very powerful tool if you're going to introduce multiple index funds into your portfolio. And then finally, the 5th question or the 5th step in picking the proper fund is understanding what other funds do they provide. So say, for example, you want to roll with VTI, which is a Vanguard fund, and you're happy with Vanguard, the way their fund is run, the way their brokerage is ran. You can start to look for other different funds that are offered by Vanguard. BND, for example, is offered by Vanguard. VTI is offered by Vanguard. VXUS, which I mentioned in this video, is offered by Vanguard. SCHD is offered by Schwab. You may want to look at things like SCHG, for example, or other Schwab funds. Same thing with Fidelity, same thing with Avantis. You need to look into the family of funds to build a proper index fund portfolio. However, you don't have to stick with just one brand or one brokerage. In fact, some people would argue, I'm just going to use this as an example, What if you had a collapse of like Lehman Brothers, for example, and all of your funds were with Lehman Brothers, right? So sometimes it is better to have index funds from different brokerages or different offerings. Now, step 3, which is the most important step, is picking a brokerage and buying the fund, which we're going to do a live demo. But before that, here's a word from today's sponsor, Policygenius. If you have anyone relying on your income, you need life insurance. It's that simple. We all hope we never need life insurance, but mortgage payments, childcare, and other expenses don't disappear when you are gone. Since life insurance typically gets more expensive as we age, now's the time to buy. Policygenius gives you a smarter way to buy and find the right coverage for you and your family. My wife and I used Policygenius when shopping for a life insurance policy after our daughter was born. Policygenius was built to modernize the life insurance industry. Their technology makes it easy to compare life insurance quotes from top companies like AIG and Prudential in just a few clicks to find your lowest price. With Policygenius, you can find life insurance policies that start at just $17 per month for $500,000 of coverage. Policygenius has licensed agents who can help you find the options that offer coverage in as little as a week and avoid unnecessary medical exams. They're not incentivized to recommend one insurer over another, so you can trust their guidance. There are no added fees, and your personal information is private. No wonder they have thousands of 5-star reviews on Google and Trustpilot. Your loved ones deserve a financial safety net. You deserve a smarter way to find and buy it. Head to policygenius.com/whiteboardfinance or click the link in the description to get your free life insurance quotes and see how much you can save. Thank you for sitting through that spot. It allows me to provide content like this for free. So now let's get into the final step of a live demo. I'm actually going to buy an index fund for you right now. So this is my Schwab account. You can do this with Robinhood. You can do this with Webull. You can do this with a million different brokerages. But I'm just going to show you Charles Schwab. So if you do have Schwab, you want to go to Trade and you want to go to All-in-One Ticket. They're pretty much all going to be the same, whether you're with Fidelity or with Robinhood or with whoever. All you have to do is find the ticker symbol that you're interested in. Remember, finding that right index fund. In this example, I'm going to use VTI. So just to give you some understanding, if you've never done this before, this is basically a ticker symbol. This is kind of like, it's like an address, okay? It's like sending mail to someone. You want to find the right thing that you want to invest in. So that's what ticker symbols are used for. You can see right here, this is what it costs per share, okay? So right now it's trading at $201.20 per share. And then you can also see the range of the day. It was anywhere from $199.62 to $205.63. You can see the 52-week range, anywhere from 174 to 244, okay? So what we're going to do is we're just going to click on buy. We're going to buy one share, and you have an order type. So you can buy this at a limit, so I can set a price saying, hey, I'm only going to buy VTI if it hits $200 per share, or I'm going to buy VTI if it hits $185 per share, right? But since for the sake of this video, I'm just going to buy a share for you, I'm going to go to a market order, which basically buys it at whatever it's trading at, in this case, $201.15. So you then go down to review order. It'll give you a little summary here. It's basically telling you, hey, Marco, you are buying one share of VTI at its market price for today only. Do you want to reinvest the dividends? I always reinvest my dividends. And it's going to be roughly $201. So then you zoom out, click place the order, and then boom. This is the order. I received it. I bought one share of VTI. So it's really as simple as that. The hard part in doing this is a few different things. So as always, I give you my thoughts at the end of the video. What I think with index fund investing is the pros. It's very simple. It's very easy to start. You don't have to sit there and analyze a million different stocks individually. You don't have to read 10K reports. You don't have to read financial statements. All you have to do is think of a higher thesis, understand what you want to invest in, and then simply just buy the index funds that track that index. It's a super, super easy way for 99.9% of people watching this video who want to invest in the market long term. You don't have to burn the midnight oil and not have a life and try and pretend like you're some, investment, analyst, when in fact that you got 3 kids, you're going to soccer practice, you're going to piano lessons, you're doing all this stuff. This is just a very easy way of building your wealth long term. The second thing is that the expense ratios are so low. I can't stress this enough, you guys. If you were to go with a traditional financial advisor, they're going to be in the neighborhood of, 0.75 to maybe 1.5%. If you go with the hedge fund, they may be, the famous 2 and 20, 2% plus some profits and all that stuff, which most of the people watching this video don't have that high of a net worth to even entertain that conversation. So for DIYers, investors such as myself, I've been doing this since I was 18 years old. I just turned 35 on December 10th. I feel like I'm getting old. I've been investing for 17 years, you guys. So index funds are the way. A majority of my net worth when it comes to stocks are in index funds personally. The only thing that I can see being a con of index fund investing, there's a few of them, but for the sake of this video, I'll just simply say that a lot of people don't have patience. Okay, they don't let the market do its thing. They get attracted to different things like 99 million different cryptos. They get attracted to things that are, shiny object syndrome, FOMO. Oh, Tesla's exploding. I'm going to buy some Tesla. Things like that. There's nothing wrong with that, but that should be a very small portion of your portfolio. Again, if you're not a professional investor or if you're not laser focused on different things such as real estate or day trading or whatever, 99.9% of you will be well served to invest in index funds for the long term. So as always, I hope you got value out of this video. Thank you for sitting through the sponsor, Policygenius. I personally use them. I'm happy to be with them because I actually use the product. And also, it allows me to make these videos to you for free. I don't sit here and try and sell you stuff. I've been doing this for 5 years now. Haven't asked you to pay a single penny for my videos. I will start to release my own products, such as Whiteboard Finance University in the future, but that's only when they're ready to be released and they're going to provide a ridiculous amount of value for the amount charged. Thank you so much for watching and have a prosperous day. Index funds, those are so boring, bro. Dude, I'm in my mom's basement, and I'm definitely smarter than the world's highest paid quants, algorithms, trading shops, hedge funds, portfolio managers, 4.7 GPA from Cornell University, lives in New York City. Mom, get the pizza rolls! I'm definitely smarter than them.